Have you ever stared at your credit card statement, looked at that interest rate, and just wondered how? How is it that high? Well, today we're going to find out. We are cracking the code on the real cost of credit cards.
Right? It's the big question. It feels like there's this whole hidden story, some kind of secret logic that we're just not supposed to understand. And you know what? There kind of is. So let's go solve this thing together.
First things first, let's just get the main number out there. In 2023, the average APR, that's annual percentage rate, on credit cards shot up to a whopping 23%. That's the number at the heart of our mystery.
And just to put that into perspective, think about other big loans you might have. Your mortgage is hanging out around 7%. A car loan, maybe 8%. Suddenly, that 23% doesn't just look high, it looks like it's from another planet. It's a totally different ballgame.
So let's officially start our investigation. We're going to follow the money, look at the evidence, and uncover the real story behind that number you see on your statement. All right, our first stop is the explanation you always hear. Oh, the rates are high to cover all the people who don't pay their bills. And, on the surface, that makes sense. But let's see if the numbers actually back that story up. To do that, we need to know a little bit of inside baseball. The term is net charge-off rate. It sounds complicated, but it's really just the official way banks measure the cost of defaults, the money they have to write off as a loss because they know they're never getting it back.
And this is where things get really interesting. Data from the New York Fed shows that the average interest spread, that's basically the bank's profit margin on the interest, is about 14.5%. But the cost of defaults, the actual charge-off rate, it's only 5.7%. You see that? That is a huge gap that defaults alone just can't explain.
So here's the first major clue. Yes, defaults are a real cost, but they don't even get us close to explaining that 23% rate. The usual suspect? It has an alibi. So we gotta dig deeper. Okay, to find our next clue, we have to look at the rulebook. And for the credit card industry, the rulebook was completely rewritten back in 2009 with a really important piece of legislation. It's called the CARD Act, and it was a total game changer for consumer protection. For instance, companies now have to give you 45 days notice before jacking up your rate. Late fees have to be reasonable. But honestly, the most powerful rule, and the one we're going to zoom in on, is all about how they handle your payments. The CARD Act gave you a bunch of other powers too. Like banks can't just slap you with an overlimit fee unless you specifically agree to it. And those kind of scary warnings on your bill that show it'll take you like 20 years to pay off your balance? Yep, that's the CARD Act trying to make the true cost crystal clear. Okay, let's get into that payment rule. I'm not kidding when I say this is probably the most powerful and also the most misunderstood part of the entire law. It's basically your secret weapon for getting out of debt faster. So here's how it works. Let's say you pay more than the minimum payment. The credit card company can take the minimum part and put it pretty much wherever they want. And yeah, they usually put it on your lowest interest balance. But, and this is the important part, every single penny you pay above that minimum amount is, by law, required to go directly toward your most expensive debt, the one with the highest APR. And that right there is the whole key. This rule literally turns every extra dollar you can afford to pay into a laser-guided missile aimed straight at your highest interest debt. It is the one move you can make that forces the system to work for you. Okay, so now we know the rules of the game, let's get back to our main investigation. We've already established that defaults aren't the whole story, so what else is hiding inside that high interest rate? The truth is, your APR is really a cocktail of different costs. And this is where we finally start to fill in that big gap we found earlier. See, defaults are a slice of the pie, sure, but they're not even the biggest slice. So what are the others? Well, there are two huge ones that nobody ever talks about: insane operating costs and something called a systemic risk premium. Let's talk about those operating costs. Get ready for this because it's a wild fact from Federal Reserve's research. Credit card banks spend 10 times more on marketing than other kinds of banks do. Not 10% more, 10 times more. And that spending isn't just an expense, it's their entire business strategy. Think about it. All those airline miles, cashback rewards, and juicy sign-up bonuses, they have to be paid for somehow. This creates this really high-cost business model for the whole industry, which guess what? They use to justify keeping your interest rates sky high to pay for it all. Now for that second hidden cost, and this one is a real mind-bender. This quote from the New York Fed nails it.
The risk with credit cards isn't just about a few people defaulting here and there. It's bigger than that. It's about systemic risk. See, when the entire economy hits a rough patch, like in a big recession, lots of people lose their jobs and default on their credit cards all at the same time. It's like a tidal wave of losses that banks can't escape. So a chunk of your interest rate is basically an insurance premium they're charging you today for the possibility of a recession tomorrow. Okay, investigation complete. We've gathered all the clues, so let's put it all together and figure out what this really means for you and your wallet. So the myth is that high rates are just about covering defaults and padding profits. But the reality is so much more complicated. We now know you're not just paying for defaults, you're also paying for everyone's airline miles and for the bank's "what if the whole economy collapses" fund. So how do you play the game knowing all this? First, and I can't say this enough, always pay more than the minimum to use that Card Act rule to your advantage. Second, know your rights. They can't just change the rules on you without notice. Third, be so careful with those zero-interest deals. They often have a nasty trap called deferred interest. And finally, remember that your rate is pretty much set in stone the day you open the card, so having a good credit score on that day is absolutely crucial. You know, we started with a pretty simple question and ended up with a really complex answer. Credit cards are not simple loans. They're an incredibly sophisticated financial product. So the last question isn't for me, it's for you. Now that you actually know the real cost hidden inside that APR, how are you going to use your credit?